Dividend investors, bonjour, this is Mike Roux, founder of Dividend Stocks Rocks and passionate investor. Today, we continue our second part of the Canadian Bank's earnings, and we are talking about Royal Bank and National Bank. National Bank, you know, it's my favorite bank, and they just killed their results. But we'll start with Royal Bank, which is actually my number 2, so it's pretty much like Christmas in advance today for me when I look at earnings. When we look at the dividend triangle, we have a pretty much similar story that we see on our previous video from yesterday with Scotiabank and BMO. So revenue going up year after year, kind of stable in 2020. We pretty know much why. When we look at earnings, we had a big drop due to the increase of provision for credit losses that happened in 2020. We expect earnings to go back up this year, so maybe it's going to take a year to recover to 2019 level, but so far, as you will see in the results today, it's quite promising for 2021. Actually a bit surprising considering that we're still in the middle of a recession and we have still people struggling with their finance, but yet banks have found ways to make more money, and overall it looks like all the government support paid off. Then again, not too much discussion on dividend this quarter. We all know that OFC has put a freeze on the dividend increases. So pretty much all banks will stay the same. Dividends are safe, so that's good, but don't expect any surprises. Now, it may take a few quarters before we see increases. In the meantime, don't forget, dividends aren't magic. So this means that if you're not getting paid dividend, the money is still in the company. So technically, the stock price should be valued a little bit more. So overall, it's still positive, and this is money in the bank for you for the next quarter, for the next year. So you don't have to worry too much about the fact that you didn't receive an increase in your paycheck this time. It's not because banks can't afford it. It's because they are not allowed to do it. That's a big difference. Looking at the results, what I love about Royal Bank is their diversification. They have the classic savings and loans for personal and commercial clients, but then they have also wealth management, capital market, insurance. So they have this great bundle of diversification and different segment, and you see right at the bottom on the bottom left, sorry. Personal commercial banking went up by 6%, wealth management net income up by 4%, and then insurance capital markets still very good, support double-digit growth, overall very strong performance here. Finally, quick note on the CET1 ratio, we're at 12.5, which is the highest CET ratio that we've seen so far. Yesterday we were at BNS and BMO around 12%. Now we're slightly over 12%, 12.5, so very strong. It's actually better than last year. So it shows you how well capitalized banks are in Canada. Therefore, your money is pretty much safe, right? Digging into the deeper in the section, we look now at the classic banking and savings and loans activities for Royal Bank. We have a similar story that we have yesterday. So basically, strong volume growth for loans and deposit, but unfortunately, what I've put in the red square, the average interest rate is a lot lower, and this obviously weighs a lot on their net income. So net interest income ended up being 4% lower than last year, mostly due to lower interest rate. We're going to get stuck in that situation for a while. Banks have to adapt, so don't expect too much from the classic savings and loans. Banks will have to count on their other growth vectors such as capital market, wealth management, or insurance to make money in this year. It will be a little bit tougher for the banking industry. Royal Bank US expansion, it pretty much saved the day for them. This segment did very well for wealth management and capital markets. You can see on the small graph here that most of their revenue is not coming from interest income, but rather from wealth management and capital market. Both sectors have done incredibly well overall, especially in the US, and this is why they have grown their revenue. Net income is up 22% from year to year, and then 33% if you compare from last quarter to this quarter. So those are very strong results once again. Net income for Royal Bank Wealth Management was up 4%. Revenue increased by 7%, mostly driven by volume and fees. So you know the drill. In wealth management, you're getting paid a percentage on the asset that you manage. The highest your assets under management, that is, the most fees that you're receiving. Once again, it went well for Royal Bank. The market recovery has helped them a lot, because now their clients are richer, and the richer their client are, the more money they're making. Part of those results were obviously offset by higher expenses. It cost a lot to pay financial planners to sell those funds and to provide those advice. And the more they bring in, the more you have to pay. So it's only normal to see expenses going up in this segment. But overall, pretty strong quarter again for Royal Bank in wealth management. A lot of growth came from capital market. We're talking about net income up 21%. And when you want to be successful in the capital market, what you need is trading, you need volume, you need fixed income, and merger acquisition. So the more trading there is, the more volatility there is, and then there are spreads that are being created, and there's a lot of room for banks to make money on the market by trading and making exchanges with other institutional traders. The fixed income segment has brought up a lot of volatility. There's a lot of interest for debts, for corporate debts, obviously. So when you have lots of volume there, the spreads are usually better, and then there's more money to be made by banks. So overall, when we have crazy period as we had over the past 12 months, it is perfect for capital market to make money, and this is exactly what Royal Bank did. Now for insurance, income is up by 11%. Mostly due to lower claims and better portfolio performances. However, revenue were down 9% on weaker sales. So overall, it's an okay quarter for insurance, but it didn't seem that way because it's more profitable. So everybody's happy, and it's still a small part of Royal Bank's business compared to their classic banking activities of wealth management and capital market. So overall, it is a pretty good, solid quarter for them. Small notes on digital adoption. I've discussed that yesterday also on my video, and if you have not seen it, maybe it's time for you to like this video and subscribe to my channel to make sure that you don't miss my quarterly updates on banks. Yesterday we discussed adoption for digital, so digital solutions, so clients using their mobile or their tablets to do their banking. We were pretty much between 50 and 55% for adoption for Scotiabank and BMO. We have a similar rate here at 56% for Royal, so we can see all banks are putting a lot of attention to it. They're pretty much making the same efforts and they have the same results, but then again, it's good to see how they intend to protect themselves against fintech and other players that are coming after their clients. Let's end this quarter for Royal Bank with what is probably the most important thing, provision on credit losses, PCLs. We have a similar trend here that we've seen yesterday. So basically what we have is a very high peak in Q2 2020, and then a little bit lower in Q3, a little bit lower in Q4, and surprisingly, Q1 2021, it's like it never happened. No pandemic, no recession, no unemployment rate going through the roof. While we still have those situations here that we have to deal with, it seems that banks are not too much affected by it, and they have reviewed their portfolio, and overall earnings are up in general, mostly because the provision for credit losses is back to normal, and basically they didn't lose that much money over that past 12 months, which is obviously good news, and it gives you a pretty good idea of what's coming up next in the coming months, coming quarters. All banks are telling you The economy is going well. It's not incredible, but it's going well enough that clients will pay their loans, then businesses won't go bankrupt. So it's a pretty strong signals. I like what I see. I'm still a bit cautious about the overall economy, to be honest, but I mean, banks probably know a lot more than me, so it's good to see them being optimists for the future. As usual, I close this segment with their exposure to COVID-19. Royal Bank is slightly more exposed than Scotiabank and BMO. Yesterday, we were talking about 4%, 4.5% of their loan portfolio exposed to COVID-19. Here, we're at 5%, so it's a little bit higher. However, when we look at the performance of this loan portfolio, they did better than expected, which is, again, very good news. So we were more afraid than what would happen, and it's better be safe than sorry. So I think Royal Bank did a good job there, and we can expect earnings to go up in the coming quarters, mostly because the PCL will slowly go back to normal, unless there's surprises. But at this point, it seems a bit unlikely, and this is one of the reasons why their stock price in general have all recovered from March crash. Now, let's talk about my favorite bank, National Bank. You can see their dividend triangle is not that different than Royal, even though it is a small bank compared to Royal Bank, obviously, in terms of assets under management and obviously market capitalization. Stock price slightly higher than what we had before March 2020, which is good news. Revenue keep going up, and what you see here in the earnings per shares, it went down in 2020, but it's not as bad as the others. Part of it was that National Bank focused a lot more on growth across wealth management, capital market, and international banking. So those division weren't hurt that much, and PCLs weren't that low, and that helped a lot their business. It also helps to have growth vectors when your banking sector, the classic savings and loans activities, are going down. For dividend, once again, very stable. They just declared a 71-cent dividend this morning. No news, no surprise here. It's just business as usual. You cash your check, you're feeling happy, and just be patient. It's all good. Looking at their overview results, revenue up double digit, earnings up 26%. That is kind of crazy. All segment contributed to that. We'll see that in a second, but they just did something amazing. They just killed their expectation again. I was a little bit disappointed by the CET1 ratio at 11.9%, the weakest one that we have seen so far. However, when you dig a little bit deeper, you realize that they're actually better than last year. So it's just by comparison to its peers, everybody's over 12%, and they're almost at 12. Yesterday I told you anything over 10 is good, so it's still 11.9, still very strong, but I would have preferred to see a good 12. Sounds good. It's in line with the others. Now they're lagging a little bit behind, but for the rest of their quarter, they're pretty much ahead of pretty much everybody. So I just love what I've seen here. Let's start with commercial and personal banking. Revenue up 3%, which is kind of surprising. Most of them in the banking industry were up 1 or 2% or sometimes down. This time we have same story. Loan portfolio is growing faster than expected, but interest rate is getting squeezed. You can see the P&C net interest margin. In Q1 2020, it was not super high at 2.21, but still better than 2.18. We can see how it goes down slowly but surely. Don't expect anything here in 2021. We'll have this very small interest net margin going forward as well. I don't expect anything from that going forward. Finally, what you see is net income is up 8%, a lot better than other banks for the PNC segment. It is not explained by revenue. Revenue is up 3-4% depending on commercial and personal loan, but the PCL is actually down by 20% versus last year, and this explains a lot. Now moving on to wealth management. Then again, same story. Clients are getting richer, the bank is getting more money on their fees, so that's great. A net income is up 20%, which is kind of like surprising. And what I really like here is they have detailed their asset under management, and they separated between individual holding and mutual funds. When you look Q1 2020 versus Q1 2021, you have the impression that maybe individual retail trading is a lot higher than mutual fund, but in fact I did a calculation. The increase with assets under management is up by 13% for individual and 12.5% for mutual fund. So pretty much they both increase about the same way. The main difference is individual investors are trading a lot more. So what you can see is transaction and others, it's up 45% year over year. So quite a feat here, and this has been explained by, retail investors. They open their brokerage account, they're getting all excited, so they buy, and then whenever they lose money or something, there's more volatility, they sell, and then they buy again, and then it goes all crazy. And this is how most brokerage firms are making a lot of money. Funny fact, I have to verify this information, but that went through my feed this morning. Wealthsimple was providing numbers, and they were saying that most retail investors lost money on a GameStop trade, GME. So you remember that meme stock in January that made a few millionaires, obviously, but a lot of retail investors actually lost money in the trade. They probably bought it wrong, and then they sold it within those huge spread when there were like the stock went up by like 100% and then went down by 50% and so on. Very hard to make money in those kind of situations because nothing is rational, and you all know that it hurts a lot when you lose money and then you get afraid, you panic, and you just sell. So just stay invested, stick to your strategy, and forget about meme stocks, and you'll be fine. And on top of that, banks will be making less money on your back. Now, financial markets. This is also a volatile segment of the business. We have seen it yesterday in a video about BMO, where sometimes on a quarter they're losing money. It's not the case for National Bank. They did a very great job, especially in structured products, ETFs, and fixed income. So we have the same great recipe here. High trading volume, lots of volatility, lots of interest for investment. There you go. Capital markets will make money in that kind of situation. The Q1 2021 was a lot better than Q1 2020. Net income is up revenue is up 26%, and then net income is up 37%. Amazing performance here. One of the reasons why National Bank's earnings are up 26% this quarter. Then again, this could be a double-edged sword. Sometimes it's going to cost your quarter, but for the time being, it has been just great news for National Bank. Let's end up with their final segment, which is U.S. international and specialty. It's obviously a lot smaller than the international segment for Scotiabank, but they're doing a lot better right now. ABA Bank, which is in Cambodia, up like net income 39% year over year. Loans are up 36%. Deposit up 41%. In other words, they are thriving. And then you have Credigy, which is a specialty credit firm based in Atlanta, Georgia, in the U.S. The revenue are up 58%. So strong performance from this small division. But yet again, National Bank expect double-digit growth for 2021 here. It is quite interesting to see how the world is shifting very fast and recovering very fast away from the pandemic. It's only good news if you are exposed to other markets. National Bank is doing it great with Cambodia and the US, so let's hope it continues in the upcoming quarter. As usual, I finish with the provision for credit losses. Then again, very similar story than others. We have a big peak and then it goes down, and then Q1 2021 is pretty much the same as 2020 or even better. In this case, it's slightly better, so it explains that National Bank is getting better results overall. It's a big part of how earnings will fluctuate. especially in a low interest rate environment where net interest rate margin, are squeezed and very thin. Well, therefore, you need to be in control of your loan portfolio. You need to make sure that you're not too exposed and that people will pay their bills. Speaking of which, the segment that are more exposed to COVID-19, National Bank, good news, it's the less exposed to the impact of the pandemic, with 3.5% of their portfolio in weaker segment, which is great news. I mean, we have seen 4%, 4.5%, 5% now for Royal Bank, and then 3.5% for National Bank. Obviously, they're a smaller bank. If they are getting hurt here, it will be worse than other banks because they don't have this incredible widespread across Canada. They're very concentrated in Quebec. We know that the pandemic has been especially tough in Quebec. I don't know what's up with us, guys, how we manage things, but we have more cases, more death, more lockdowns. So hopefully moving forward, it's still going to be good, but so far, so good. So I just love the fact that there's a small exposure there, and from my banking experience, I've known that banks don't like restaurant and hotels in general anyway. They just don't want to finance those activities, so they go very, very cautiously, and when they do it, they take security like there's no tomorrow. You don't want to make sure that everybody's on board here and they're not left with empty buildings. It looks like it's paying well right now, so kudos to all banks to be very careful with their loan portfolio. Speaking of being careful, I want to finish this presentation with the slides. National Bank used to have a sizable exposure to the oil and gas market. Back in 2015, it was 3.7% of their portfolio. Now we're down to 1.4%. While it may have seemed to be a bank that doesn't want to lend anymore to the oil and gas, and it may hurt their reputation, I think that moving forward, it's a good thinking. Especially, when you're a bank, you want stability, you want sure shots, and obviously, right now, oil market is recovering, and we can probably expect a boom in 2021 for many of those companies because now the barrel is going up like there's no tomorrow. There's obviously a delay between the supply and demand, which is pushing the oil price a little bit higher. But when you think about the next 5 years, the next 10 years, the next 15 years, one thing is for sure, you will have to expect a lot of volatility, and from time to time you'll have bad news from your client saying, you know what, the business is not running right now, the oil market is tumbling once again, we can pay our loans. So overall, I think it's a good move for the future. It will stabilize their portfolio, and at 1.4% of their portfolio exposed to oil and gas, that is like nothing will happen even if the oil market crumbles. I prefer that. Actually, I think that the future for banks are not in the savings and loans. Obviously, it is classic activity and it's a good anchor for client. But if you're not able to go into capital market, wealth management, and other kind of products like this, you are not going to be able to make money on the in the financial world. I think banks have understood that. They are doing it well, and National Bank have done that a while ago, probably mostly because they were stuck in Quebec and they were having a hard time opening branches outside of this province. So they thought, we need to increase our exposure and expand our business throughout different growth vectors because the branch business model is not working for us. And it led them to expand their division like this. Great success here. So I hope that you have enjoyed this video. Once again, please do your due diligence. Don't take this as financial advice. You need to do your own research before you're making any purchases. Even though I love National Bank, you may lose money on it. So don't forget about that. And until next video, stay invested.